Hi, everyone. We're live again with All Access with me. Thank you for joining us. This is only the second version of this podcast. And we're slowly trying to figure out how this whole thing works. We're slowly trying to get over the technical glitches and so forth. And but I do hope you enjoyed the first live stream last week. I certainly did. It is a new format for us. It's a new style and a new thing for me. And we'll try to make it better each week. We're very, very glad to have you back. For those of you who are new, All Access is a weekly live stream where I get to share what's on my mind and what's happening in crypto at the moment. Sometimes I'll talk about exciting new updates about Avalanche, but most of the time there'll be other things that are on my mind, generally concerning crypto, generally concerning perhaps other topics related to distributed systems, perhaps to fintech. And if there are specific things you want me to cover, then send me your questions in the comments below or on Twitter DMs. But let's get started. There's a lot of exciting things happening this week. Well, one of the most interesting things, at least from my perspective, that happened this week was a comparison of Solana versus Avalanche. So Kevin Sekniki performed a very simple comparison. He did an apples to apples, actual, no bullshit, no cheating kind of a comparison, where essentially what he does is he submits a transaction and he checks until the transaction is final. That's the test. There is no frills, no gimmicks. We're not going to allow the underlying system to mask the latencies. We're not going to do zero conf. We know that everybody can be super fast if you do zero confirmation transactions. If you want to YOLO your trades, then sure, of course they're fast. You give me the trade, you YOLO it, and maybe I'll execute it, maybe not. But certainly I can absorb that trade really fast, and I can make it appear as if it took place, even though it's not final. That is not what blockchains are about. That's just essentially putting lipstick on a pig, and so we are not counting that. What we're doing is simply injecting a transaction and then waiting for it to be final. I'm trying to bring up this link on my screen, but I won't be able to share it with you easily. So what I'm going to do is tell you what he found. The time to finalization on Solana is somewhere between 15 to 20 something seconds. That's how fast that supposedly fast system is. In comparison, the same time is about a second for Avalanche, as we have always advertised. So we're about 15 times to 20 times faster than Solana. Now, you can do all sorts of other fake numbers per second tricks. Okay, what are the fake numbers per second tricks? There's so many. And certainly there are projects out there that are experts at this. There are database researchers who used to be experts at this as well. When I was an academic and I was a professor, I watched other groups make up a gazillion numbers per second about how many transactions per second their systems could do. So we know all the tricks. So if you have a slow system, it takes 20 seconds to carry out a transaction, let's say, and you want to sort of appear on top of something that's genuinely faster. Here is what you can do. You can take the transactions and in the UI, you pretend that they're final. That's the first thing you can do. Well, that transaction isn't final. You're lying to the user. So therefore, you're YOLOing things. And there will be hell to pay at some point in not very far actually from now. The second thing you can do is instead of taking one transaction, you batch them. So, the other normal people submit one transaction at a time. In your benchmarks, you submit a gazillion transactions at a time. And so you can add, whatever your number is in terms of transactions per second, you can multiply them with any factor you like. And the only thing limiting you is your own sense of honor. So you could just bullshit any number you like. You could multiply, you could say, hey, here's 1 million transactions. I'm going to send you the Merkle root hash of 1 million transactions. You decide on that one. And even though my system makes one decision per day, and suddenly it's making 1 million decisions per day, it's suddenly got 1 million times faster. Now it's the same dumb, slow system you always had. It's just that somebody played a trick with the client that's submitting the transaction. And instead of counting one submitted transaction as one thing, they're counting it as 1 million things. That's in my opinion, that's just blatant fraud. and it just should not be done that way. Now, another trick you can do is the following. Every protocol to finalize a transaction has to send messages. Now, that's the whole process of achieving consensus. I have some machines, you have some machines, they all need to be in sync, they all need to make decisions, take decisions in tandem, in lockstep. And to make that happen, we need to closely couple them. They need to message each other. Now, there are good protocols for keeping them in lockstep, and there are crappier protocols that take a lot more time, a lot more effort to keep them in lockstep. Some protocols are, in fact, most protocols are O of n squared in the number of bits transmitted. What does that mean? If you have 1,000 validators, well, then you're going to need n squared, 1,000 squared messages. If you have, whatever, 1,000,000 validators, is going to be about 1 trillion messages, completely infeasible, etc. And some other protocols like Avalanche are incredibly efficient. And Avalanche requires something on the order of log messages in the number of participants. That's why it scales so well with large numbers of participants. So there are efficient protocols, and then there are less efficient protocols. Well, if you go and count the messages sent by the protocol as if they're transactions, you will boost your numbers. And in fact, the worse your protocol is, the crappier it is, the less you worked on it, the less innovation you have, the more into ancient history of distributed systems you went, and the worse a system you picked, the worse a protocol you picked, the higher your numbers are going to be. So Solana does that. Solana counts the messages sent by the participants as if they're genuine transactions. Those are not genuine transactions. They're not user submitted. They're not carrying out client work. That's just the internal accounting that Solana had to do that nobody got to see, should have seen actually. So that's complete lying, I think, in their accounting, and that's how they got those. That's how they get these this high TPS. And in fact, when they had their safety failure about a month ago, they were talking about having 400,000 transactions per second. That wasn't 400,000 submitted transactions per second. What they had is a failure of the protocol. All of the nodes are going haywire. They're having a packet storm, and somehow they decided to pitch this to the public as if this was a 400,000 transactions per second system that's clearing that many user-submitted transactions. I was very supportive of Solana during their safety failure. Systems can have failures. That whole spin that they tried to put on the situation left a really bad taste in everybody's mouths who understand how these systems work behind the scenes. And when you see any kind of a thing like this, I hope that those of you who have the wherewithal to look into what I'm saying can verify everything I said. And I hope that in the future you will raise an eyebrow, and we have to police ourselves. The academic community failed to do this. And in many cases, there are a bunch of people who made a career out of lying with numbers, with fake numbers per second. And we can't have that happen in this space. Sadly, the valuations and sadly, the amount of attention paid in blockchains is a speculative affair as opposed to project-driven or value-driven affair. So you can get very far with fake numbers per second. And we can't let that happen because it feels wrong. It's unethical to do it. So anyhow, that's been on my mind. Kevin did a very simple the apples to apples comparison, and he found that indeed Avalanche is 15 to 20 times faster than Solana when you look at it. When you look at the time to finality, from the time a transaction is submitted to the time it's actually finalized. The second issue that's been on my mind is the value these systems propose. Like, what's the value provided by them? And there's a very easy, hard to fake way of measuring the value systems provide. And that's simply to look at the amount of fees paid. So in systems that provide higher value, then people are willing to pay higher and higher aggregate fees. Now, you want to be a little careful here. It's a bit nuanced. You don't want to build a system where each transaction is expensive. The ideal situation to be in is to be able to clear a lot of transactions, each of which pays a very small fee, but in aggregate, the fees paid is very high. And in fact, a cherry on top here would be if you could take the fees and you could burn them. So in systems like Bitcoin, the fees are paid to the miners. The miners then usurp them. They use it to pay their power bills, etc. To the power company, the value leaks out of the value, the store of value. In a system like Avalanche, the fees are burned, and that's a great way to make sure that the value spent by the users of the system get translated into value increase for the people who are holding the coin. So that's sort of what would be the best scenario. And if you look at value, the fees spent, Avalanche is about 5x higher than Solana today. It's not surprising. The system is actually big. There's a lot of value in the DeFi system, and it's nice to be in that situation. So that's been on my mind. It's very stark. I try not to point this out. You know, we live in an age, especially the younger generations. It's like you don't want to be a hater. You don't want to sound like one. We're not haters. As I said, I was a big supporter of Natalie when they had their safety failure. Generally, a big supporter of anybody who has genuine innovation to bring. But we do have to police each other. We really can't let people just run wild. There are limits to what you can say that are scientifically true, and when people start to stretch that, then there should be some people who step in and say, hey, this does not make sense. Okay, so on a different note, there has been another topic that's been on my mind that I'm super excited about. It has nothing to do with distributed systems. It has everything to do with digital assets. As you know, when we started going down this path of building new systems, we started getting really excited about Avalanche, and we started getting excited about digitization of all of the world's assets. So there is a lot of value out there, many trillions of value, not in blockchain form. And I think I shared with you my vision for the future, which is that we will start to put these things into digital form. It will not happen the way people think it will. It will not happen the way a lot of OGs in crypto told you it will. It'll happen exactly how I told everybody it will, which is this. We're not playing a zero-sum game. We're not trying to carve out value from each other. There's that, you could play that game. You could have a layer 2 or a system that pretends to be a layer 2. You can have a system that carves out value from Ethereum, etc. That's not where the action is going to be. The action is going to be in the new assets that come into the space. The action is going to be in growing the space. And systems that can absorb that growth, both by scale, also by having the flexibility to provide a good environment, a legally compliant platform, a technically competent platform for those assets to be digitized, are going to be the big winners in the long term. And again, a lot of people thought, hey, once we start doing something with money, then suddenly other assets that currently exist and for which we have all these silos, they will flip. That is, we're going to go from Bitcoin is going to be very big, and then suddenly stocks are going to be traded on the blockchain immediately. They're going to go, Apple stock is going to be on the blockchain, NASDAQ and NYSE are going to be on the blockchain. While that, I believe that to be true, that is, as all assets will be in blockchain form, I think the last ones to come onto blockchain form are going to be those for which we currently have established silos. Today, the equity markets in the US are very well established. The incumbents are very big. It's going to be fairly difficult to penetrate that, at least in the short term. So the efforts to get those on board, of course, they're ongoing. We're working on that at Avalanche. But I don't expect that to happen overnight, nor should you. I don't think you're going to hear an announcement tomorrow that says, hey, NASDAQ is using blockchains for all this trading. It's just not, we're not there. What instead we will see is an explosion of new assets, brand new assets, things that people are doing for the first time in crypto form. And these will grow in size, and they'll grow to be so big that at some point, the other established markets will look small in comparison, and that's when they come over, that's when they patch over. So with this vision in mind, we started from the get-go 2.5 years ago. That we decided that we need to actually be at the forefront of inventing and carrying into blockchain form new digital assets. And I'm really happy and really proud to report that one of these new asset types just went live this week. In particular, I'm referring to initial litigation offerings, ILOs. What's an initial litigation offering? I'm sure you've heard of people in the US who have a legitimate lawsuit. They have a legitimate gripe. They were wronged somehow. And they want to pursue a lawsuit against somebody, but that somebody typically has big pockets. It's either a normal citizen against a very, very, very big corporation, or a normal person against the state. And in both cases, you're running up against a behemoth, a giant engine, and it's going to be very hard to fight that fight. And often what they can do, the other side doesn't have to win in court. They just have to wear you out. If they wear you out to the point where you run out of the limits of your wallet, then they win. Okay, you have to settle at some point. It's just going to be too costly. And even if you win something, well, then all of it is going to go to the lawyers and not to you. So you do this differential equation. Essentially, you have to find the optimal point of how far you want to push things. And often you have to settle for something far less than what you could have gotten. So what has sprung up in the US is a new form of financing for litigation. It's called litigation financing. There are a couple of firms that are very, very successful, and they have been making about 30% per year for the last decade. So this is a very, very big field. And if you were an LP, if you were a founder of one of these firms, for every $100 you put in, you would get $30 every year for at least a decade. And so it's a very lucrative game. So there are very few other assets return that large an amount. And it's not a volatile return, by the way, right? So if you look at these firms, it's actually very steady, unlike crypto, whose value can fluctuate. And there are a whole bunch of issues with crypto markets and crypto prices, as you all well know. This is a traditional kind of an investment, right? You're putting your money into financing someone's lawsuit. So in a first this week, a law firm that is very well known in crypto circles, I would say one of the best litigators in crypto circles, coupled with Republic, which is a firm that is led by another lawyer, by the way, and a firm that is known for compliant token sales, decided to offer the world's first initial litigation offering. What this means is they're offering on the blockchain a set of tokens that people can buy. And if you buy this token, what you're doing is you're donating or whatever, you're giving money to the legal team on one side of a lawsuit. If that person wins, then the winnings, some amount of the winnings come back to you. In the very first ILO, we have a case of Dr. Trent Jones, who essentially was, I think, a math professor or a math teacher in Michigan. And he's an older person. He ended up moving, in his late 50s or 60s, he decided to move down to the Mojave Desert. He grew some hemp there, and once he decided that he had bred a particular set of genetics that he was really proud of, these are really huge hemp plants. He decided to get a license and grow it at production scale in California, and that's exactly what he did. And when he was doing this in Kern County in California, the local sheriff did not like this. And as you well know, hemp and marijuana plants look very similar. And I think the allegations are that the sheriff ended up unlawfully destroying the crops. So there's a lawsuit around this. The exact situation, of course, is going to be sorted out in court. Whether or not there were permits acquired legally, whether or not everything was up to par, and whether or not the sheriff served and followed due process. And the allegations are that he served something on Friday night, and by Sunday evening, about 500 acres of the crop were destroyed. Now, 500 acres of the crop correspond to about $1 billion of value. So if Trent Jones wins his case, it's the Apotheo is the name of his company. If Apotheo wins, the state of California is liable for about $1 billion in crop destruction, making this the largest case of crop destruction in the US. It's an interesting case. So let's see. So Trent Jones is in need of some financing for his lawsuit, and Roche Friedman and Republic have just done a token offering to finance that lawsuit. So, and the way the token offering is structured, there's a payout matrix. Depending on how soon the case is settled or decided. If you put in $1, you get, I think, 3.5 if it happens quickly, and or vice versa. I forget exactly how it's structured, but you get something like somewhere around 2x to 3x of your money, depending on the timing. And of course, there's always risks associated with this. There's a risk that Trent Jones and Apotheo will lose, and if that happens, you get nothing back. But in any case, it's really fascinating from a blockchain angle, because now we have on the blockchain a set of tokens that represent the outcome of a lawsuit. And now we have a way to show our support for causes that we care about. Now, plaintiffs have a way to finance their gripes against other people with deep pockets. And all of this is happening on the Avalanche blockchain. So I was really excited to see this. If you go to republic.co/apotheo, APOTHIO, so republic.co/apotheo, then you can take a look at the conditions. I think most of the money that Apotheo wanted to raise has been raised by now, but take a look and see for yourself, and see if this is a cause you like, and see if this is something you'd be interested in. I certainly took a look, and it seems like a really, at least to me, it sounds like a very, very interesting way of opening up the litigation process for people to participate. So that was the second big thing this week that got me really excited. It's a brand new asset class. These things don't get created all that often. Litigation financing is its own thing. It's not a company. It's just litigation, and it's got specific rules associated with it. And Roche Friedman and Republic have done the necessary legal groundwork for doing this offering, I think. So we're looking at the birth of a new asset class. It's going to be really, really interesting. And from my perspective, as somebody who loves Avalanche, it's great to see it on top of Avalanche, of course. But from my perspective, as somebody who likes to see new assets, then it's wonderful to see yet another asset class in blockchain form. So going back to the prior discussion topic, we will see more of these alternative assets come to be on blockchains. And I think there are some meta lessons that are kind of important and should not be overlooked. There are lots of teams out there. There are lots of projects. Most of them bring no innovation, right? You take the Geth code, you run it on a laptop, you call yourself a layer 2, and then whatever. Then you try to buy your way to legitimacy, etc. You try to buy projects that make you a genuine layer 2 later on. Like there's just all possible things you could do. But then there are projects out there that are genuinely trying to make the pie bigger for everyone. And you can't make that stuff up. I mean, it's very clear and clear as day and night. There are teams out there that are trying to make the space bigger, that are trying to expand the limits of blockchains, that bring goodness to everybody. And I'm really proud that some of that is taking place on top of the Avalanche blockchain. So those were my thoughts this week. I was really excited to see what happened. I was really excited to see how the ILOs came out. I was really excited to see that the performance comparisons that are fair, where one side is not engaging in fake numbers per second marketing versus genuine normal measurements. The metrics align exactly as one would think, exactly as science would tell us that they would. So that's an interesting situation to be in. Those were the two main thoughts I had. Let's see. So that sort of sums up my big issues from the week. Let's see. There were a couple of questions I got from last week. So one of them is, it says, you said that Avax's only rival is neither Bitcoin nor ETH. That's correct. It's Wall Street. Absolutely. We are here to reimagine finance. We're here to build a new foundation for it. How is it possible to beat Wall Street? Oh, it's pretty simple. You start out with alternative assets. I just talked about ILOs. And there are many others like this. There are no incumbents. There's nobody who's there to come after you with his, buddies, with his moats, with his, friends in the regulatory business, etc. So, and there's, if there are, in cases where there are few incumbents, it's pretty straightforward to come up with blockchainified solutions that perhaps might establish a market. And as that happens, those markets will grow. And at some point, they'll be so unmistakably big that the more traditional markets will start to patch over. At the same time, there are funny things happening. I think I mentioned this last week, but blockchains are so much more fun and exciting compared to the technical infrastructure that powers Wall Street. So if you know how those systems work, the settlement systems work, there's COBOL code in there from the 70s, and the people who could hack it are slowly beginning to die off, and the code is still living on, right? So it's interesting, and so you've got those archaic systems, and you've got the elegance, the openness, the flatness of blockchain-based systems, and you've got the innovation taking place. It's kind of like how, I don't know if you guys remember how telephone systems were. Telephone systems are silos, right? The AT&Ts of the world, the Nortels of the world own those systems. And you and I could not innovate. Why? Because the brains of the system were in the network. And all we had was a stupid telephone, right? You pick it up, you've got the rotary telephone, you got the, more recent vintage, you've got the buttons. But that's all you can do is you can send little signals down the wire to tell the server what to do on your behalf. And all the intelligence was on the server side. Now, what happened after that was with mobile phones and with smartphones, the whole situation got flipped. The architecture got flipped. The internet flipped it. The internet flipped telephony. Why? Because it gave you a dumb network with intelligence at the edges. It gave you access to intelligence inside the network. And that process is playing itself out with blockchains. We're going from financial systems that are closed, that are siloed, that are under the control of incumbents, where all you can do is, would you like to submit a market order or a limit order? To suddenly, hey, you can write a smart contract. You can build a lending platform of your own choosing. You can do flash loans. And that is how you suddenly open it up. The sky is the limit when it comes to DeFi, and folks on Wall Street can see this. They have a lot of concerns, and legitimate ones. They are under very strict regulatory compliance regime, and they should be. They need to make sure that, for example, on the other side of a trade, doesn't lie somebody against whom we have an embargo, right? You don't want to be trading with the North Koreans, etc. So current blockchain technology does not allow them to actually accommodate that. And but they can see that the technology is there. It just needs an extra push to get to what Wall Street needs. I think in the next 2 years, we're going to see that push come to fruition. I think it's not going to be too long from where we are now, because everyone on Wall Street has tasted this new technology and they can see the writing on the wall. And just as clearly internet took over from telephony, we're going to see a very similar. Now, currently, if you pick up the phone, you have an IP line, right? Your dumb desktop phone is no longer like the old ones. It's actually quite capable. It's a smart device. Similar thing is going to happen where suddenly just the same way we got rid of the SS7 signaling protocols for telephony. We didn't get rid of them. They still exist, etc. But they've been pushed aside and everyone's using now internet telephony. We're going to see a transition from the old to the new world. Can you talk about subnets, about plans and use cases? Yes, I can. I can't talk about plans. I'm not going to make too many forward-looking statements about Avalanche on this podcast. But I can talk about subnets and use cases. That's pretty easy. Subnets allow us to have specialized blockchains within the Avalanche fold. So you can create your own subnet. You can stake in that subnet with your own tokens. You can restrict the behavior of that subnet to anything you like. It's all up to you. And you can have a subnet where the tokens are minted by proof of work. You can have a subnet that, for example, uses Bitcoin mining equipment to mine Bitcoin-like tokens, uses the Bitcoin virtual machine to transact like Bitcoin, so therefore supports Bitcoin-like wallets. But all of the settlement is done via Avalanche. So you have the speed of Avalanche, but the minting and the infrastructure of Bitcoin. So that's an interesting thing. You could do that. You can have, for all these systems that wanted to be on proof of stake but could not figure out how to do it. Well, you could take, for example, all of the balances from Ethereum and put them on a subnet and suddenly facilitate, whatever you like. You essentially created Ethereum 2.0, and you can just do this. This could be done essentially immediately. So I can go on like this. You could create subnets where all the participants are subject to KYC if you wanted to, and that's certainly something that we're looking into with partners. So what you can do is you can create walled gardens that Wall Street could use. Certainly something that we are looking into. So this is all exciting stuff, and I can go on and on. Like there's so many exciting uses for subnets and specialized virtual machines that the sky is the limit. Avalanche gives you control over the network in a way that most systems don't. Avalanche gives you the flexibility to run your own virtual machine inside your own subnet, and that combination is a pretty powerful one. And again, it's up to the user community to take advantage of this fully, and we are certainly, I am personally very excited about specific uses. Let's see, what are some other questions? What do you think about blockchains that employ sharding? I'm not going to answer this today because I think I've gone on for 40 minutes. But I think my position, I've made it very clear from the get-go. Sharding is what, if I were to take someone and if I were to make them a graduate student in distributed systems, like after the first month, they get a feel for the area, they get the lingo down. After the third month, they would latch on to sharding as the solution to everything. You give them a problem and you say, make this high performance, they're like, oh, I know how to shard it. Okay, so similar things happen in other areas as well, right? So you give people an optimization platform problem, they will find a way to parallelize it, right? That's what you do. In the early 90s, you could get a thesis by taking any problem, matrix multiplication. You come up with a way to do it in parallel. You get a thesis, etc. You do whatever sorting, make it more parallel. That's 70s kind of a thesis. So so there are things in that you can just apply this hammer to. And sharding is a hammer. It's a well-known hammer. It's been around for a gazillion decades. So a couple decades, right? So our field is not that old. It's only 45, 50 years old. So it's been around for a few decades. The problem with sharding is the following. If you do sharding the way ETH 2.0 initially wanted to do sharding, which is randomly assign load to the shards, then in a blockchain setting, things don't work because people don't like being randomly assigned to the shards. They will much rather be assigned to certain popular shards. So you have this grinding problem where people grind until they come up with the right hash that assigns them to the popular shard. And which ones might be popular? Well, the one with all the DeFi would be popular, right? So everybody will want to be on the one with DAI, with MakerDAO, and that's going to be the default shard for people. So you've got a sharding problem. You've got a problem, a grinding problem, if you do random sharding like most people want to do. If you don't do that, okay, and that's typically where we are now. People are talking about sharding, but they realize that because of grinding, they can't do random assignment. So suddenly that load balancing that you get from sharding is no longer applicable. Then what can you do? Well, what you'll end up having is, suppose you take a blockchain that's overloaded, that's got a problem. and you decide, I'm going to fix this problem by sharding it k different ways. I'm going to have k parallel blockchains. Well, what do you have now? Well, what you have now in your hands is you had one problem. Now you have k problems. The original problem is exactly as hard as it was, because that thing is still continuing and it's got a big load issue, and you didn't do anything to solve that one. Nobody will want to be in the other less popular shards, at least not initially, and probably for a long time to come. Plus, you created for yourself the K plus first problem, which is inter-shard communication. Now, I'm not even getting into data availability. Whenever you have sharding, the premise of sharding is that I can participate in a system and not listen to or follow everything that happens in it. If I have to follow everything that happens in it, then obviously the sharding is buying me nothing. My bandwidth has to be sufficient to be able to absorb all of the traffic. And that was the reason why I sharded, is I didn't want to deal with the entirety of the traffic on the chain. So if I am not personally checking everything that happens, then things can happen that I didn't look at, that I may not be able to access later on when I need to. And that's the data availability problem. It's a big problem, and I haven't seen an adequate solution for it. So it just doesn't exist. And so I'm very happy to sort of listen to solutions that claim that this could be solved. I believe that my student Kai Mast is the only person who did any work on this issue. And his thesis contains, I believe, what I think is the only sound sharding system for blockchains. But I'm very happy. I'm delighted to see other people make headway, around this problem. So what I think I will do is I will slowly sit here. I've been saying the same thing about sharding for many years now, and I can't wait to see it come to fruition. The specs I have seen of sharded systems have typically had substantial gaps in them. So I think it's going to be an interesting game. I've been told repeatedly that a sharded version of Ethereum, sharded ETH2O, was around the corner. It was happening. And it's, it doesn't seem like it's happening. So it's all I'm going to say. I wish that group the best. I love Ethereum 1.0. It's a fantastic system, but Ethereum 2.0 as a system architect, I don't find a compelling design or architecture for it. So I cannot wait to see that architecture get flushed out. I cannot wait to see a full comprehensive spec for it. So let's see, here's a different question, totally different kind. Do you find that there to be a shortage of prospective grad students in Ivy League institutions like Cornell? No, there isn't a shortage of graduate students. And it is true that industry is paying incredibly well these days. And it is true that we are getting fewer students than we used to. That's true. This is a very interesting topic. There's so much more to say. But overall, it seems to me that we have a very healthy supply of people who are going on to graduate study. And the kind of people who want to do graduate study are they know themselves, right? So it's not, if you really have the fire to really go deep in a particular area, really advance the state of human knowledge in an area, then it's something that burns you. And no amount of money dangled in front of you by people who build surveillance systems, essentially what we call whatever it is. You know what I'm talking about. The Facebooks or the Metas of the world, etc. No amount of money that they can dangle in front of you will sway you. So yeah, at Cornell, I had access to, I think, the top most talent in the world. And it's a great cadre of, it's a great batch of people. And I don't think that they were affected much by what was happening outside an industry. Is that always going to be so? I don't know. But at the moment, I don't see a shortage. And I'm grateful for it. It's great to have the sort of the best minds go into advancing our knowledge as humankind. So that's, I think, sort of it. These are sort of potpourri of questions from last week. There are a couple more, but I don't have that much time. So what I think I'm going to do is stop here. And thank you all very, very much for bearing with me as I ranted around some benchmarks, as I shared with you my excitement about ILOs and other alternative assets. And so thank you again. This session, I think, went a lot smoother. And I think this is going to be a fun time each week being on live stream with you again. And once again, if there are topics that you want me to discuss, then send me messages and we'll discuss them here. And in the meantime, have a great time, good bridging, and have fun. See you on the blockchain. Oh, and happy Halloween.